This episode is brought to you by Van Eck. Rare earth metals are the hidden backbone of modern technology and defense, powering everything from smartphones and electric vehicles to fighter jets and wind turbines. Van Eck recognized this early, launching the Rare Earth and Strategic Metals ETF, ticker REMX, 15 years ago, well before supply chain security became a global priority. Today, China dominates the production and refining capacity of rare earths, creating real challenges for global supply security, as these materials are essential for technological innovation, clean energy, and national security. That's why countries around the world are racing to build their own supply chains and reduce reliance on China. As this global shift continues, investment in the rare earth ecosystem is growing rapidly, from mining to advanced manufacturing. Investors can access this powerful trend through REMX. Visit vaneck.com/REMX compound to learn more.
Hello, and welcome to Live from the Compound. Who is Brian Belski? All right, today we're going to have a lot of fun. You have a really big news to share with the audience. I want to set this up for a moment.
Yeah.
Guys, on the compound, we have our regular guests, and then we have our regular guests, the people that the crowd goes crazy for every time they're on. They make a huge impact, and people are always asking for more. When are you going to have so-and-so back? One of our regulars is here announcing the launch of his own firm. We're super excited to have him back. It's a special edition of Live from the Compound. We're literally live, not on Zoom, and we're here with our friend, Brian Belski. Brian, welcome back to the show. How are you?
Thanks so much for having us.
Okay.
It's amazing.
What will you be revealing today?
We're revealing our new firm.
Okay.
And it's called Humilis Investment Strategies.
Humalis Investment Strategies.
Investment Strategies, yeah.
Strategies.
Humilis Investment Strategies with the acronym HIS. And the way I think about it, it's all his anyway. And when I talk about investing, you have to have a lot of humility when you invest, period. And humilis is Latin for humble. So a lot of people are like, Belski, you're not humble. I mean, no, I actually am very much so. But we have a lot of conviction on how we talk about things. So our tagline is investing with conviction and humility. Because
so you have a high conviction, but it's in the need to be humble.
Correct.
I got you. I like
that.
Yeah, I do.
So, how did I come up with this whole tagline? So, do you remember Louis Rukeyser?
Yes.
So, I remember
our YouTube audience will remember him well.
Yeah, look it up on the internet.
They
machine.
are the great grandchildren of his viewers, so they'll remember.
So, I remember you go to Owings Mills, Maryland, and it was a Friday night, December of 2000, and I was so nervous, man. I was so nervous to be on. Laszlo Barini was on with Mary Farrell and Louis Rukeyser. And I'm nervous, and I'm like, what do I do? What do I do? How do I get through this? And I started praying, and there's this really important scripture that I've always said right before I do any public speech, and it started that night. It's Micah 6:8. It's from the Old Testament. It says, God asks you to do a lot of things, but you absolutely positively must act justly, love mercy, and walk humbly. To this day, I still quote that before I go on every single television show, before I go up and do a speech. It just grounds me. So we're not going to be right all the time in this business.
Well, that's the line that got you through that first big appearance. For people that don't know, Louis Rukeyser show, what was it called?
Wall Street Week.
Wall Street Week. So it was every Friday night. It was like the markets
PBS,
closed.
Yep.
And then it would air on PBS. But it predates CNBC. And for a fairly long period of time, it was the last word in who knew what they were talking about on Wall Street.
Correct.
Okay.
Correct.
So that got you through there, and you've maintained that idea.
Yep.
Okay.
I maintained that. And that's what really got. So then as I started this process about, okay, working for the man for all those years is fantastic. When you work for great places like amazing time at BMO and then Oppenheimer for a couple of years before that, and then my amazing time at Merrill Lynch, Piper, Dane. You meet amazing people and you go through a lot of great things, and you learn a tremendous amount of things about a business and in this business in particular. But at the end of the day, this business is all about relationships, period. And we've been very blessed to have great relationships all along. So I wanted to capitalize on those relationships. And quite frankly, when you're doing 3 jobs, when you're doing institutional strategy for Canada, institutional strategy for the US, and portfolios, it's a lot.
Yeah.
It was time to kind of focus on one, and that's why we decided let's focus on portfolio strategy. Let's focus on our separately managed account business and running equities in both Canada and the United States. And we decided to pull the trigger.
Okay, so now this is going to be the way you manage money going forward.
Mm-hmm.
It's your own firm. You'll have active strategies
Yep.
on the stock market.
Yep.
And you'll now be in a position to focus on that and not focus on the priorities of a much larger corporation that's doing a lot more things.
Yeah, like say for
So
instance,
you're doubling down on doing stock market stuff for the people that trust you with
Right.
their investments.
So in the institutional strategy world, you have to publish all these great research reports. And one of the ones that we've done for years is called the chart book. We've published a chart book since 1996 or 7. And so on the institutional side, we'd get a call from Point72 or Millennium or something. Hey, Belski, can you walk me through this return on equity model for industrials and how that works and what are the signals? That takes a tremendous amount of energy and research to try to figure that out. Where it's not like we're not going to do that anymore, but we're not going to be that literally pointed in terms of institutional, just to try to prove to people that we know how to do things with respect to calling the market. I've said for a long time that the stock market is a market of stocks. Too many people that do what I do are so focused on the index and make it the big market call all the time. And obviously institutions want to try to figure out and make sure that you're a tool in their tool belt in terms of how they're running their portfolios or what they're thinking about. But we just want to run portfolios. We just want to talk stocks. We're part of to quote the movie Stripes, we're the last of a lost generation. I mean, we like to tell stories and talk about companies and how they relate to your life. And that's one of my rules of investing. Investing is like life and life is like investing. If you think about it, why do you like to go to Costco? I mean, why do you like to buy Apple? Why do you buy Netflix? Think about how important these great American companies were during COVID, whether or not it's Netflix or Google or Zoom, or think about that. We could not have gotten through COVID without these great American companies.
How many great American companies are you going to be owning in your model portfolios? What does this look like?
Great question. So that's where the conviction comes in. So again, rule number 3 of investing is I don't know everything. In fact, I'm not the smartest person in this room. There's a lot more smarter people in this room than me, but I think I know a lot about the 50 companies we run in terms of our U.S. focused portfolio. I don't need to know a lot about the 450 companies that we don't own, but I think I know enough about the 50 companies. Typically in large cap money, we've proven through all this fancy back testing, 50 is a pretty good number. And so from the U.S. focused portfolio, we're going to follow through with respect to what we're thinking on sectors and industries and our themes from a fundamental perspective. So we feel really comfortable with 50 companies as much of a 6% position and as small as 1%. In our small mid-cap portfolio, which we've talked about on the show here, I mean, as a parent, you're not supposed to have a favorite child,
Right.
but this is my favorite child,
Yeah.
the SMID, because you can play themes and stocks and stories. And so around 65 to 75, because the risk spectrum is a
So
little
you'll
bit
own
different.
more stocks in that category.
Yep.
I guess that makes sense. You would want to be more diversified
Yep.
as the cap size falls if you're trying to capture more of those individual stories.
Right. So here's a great
Versus
example.
like a macro bet.
Right. So if you're
Okay.
going to if you're loving, like we doubled down on Google earlier this year when everybody thought no one was going to use search again, right? Or Apple. Like, say if we have a 6% position in Apple in a large cap portfolio, we're still going to be kind of underweight, 6%. But in our SMID cap portfolio, we love this company Celsius. I've owned it for a long time. You think I'm going to have a 6% position of Celsius?
The energy drink. They're killing.
Delicious. Or Shake Shack. I mean,
Right.
that doesn't make
So you
sense.
need more names because you're not going to take a 6% bet.
Correct.
Okay, got it.
So where we think we're different is not just because of our approach of doing, frankly, market strategy for all these years, but actually really live running money. We started in 2005 officially when we were at Merrill Lynch. But I think that we've always proven that we put our money where our mouth is. And because we were FINRA registered analyst, we had to write the research report first, then it was published to the world, and then all the portfolios come out. But I think where we're differentiated now is we're not just tech, we're not just go momentum, we're not just large cap. We've always thought of the market holistically from an equity perspective. So whether or not it's SMID, which we love, which we don't think people own enough of, but that's a whole other perspective. Value, we love value stocks here, like intrinsic fundamental value stocks, and then dividend growth because of the income. We focus on those companies that grow the dividend over time and have a proven track record, not about yields, but dividend growth. So where we're going with the market, we think ultimately is that the market, we've been talking about it, we meaning the collective market people have been talking about broadening out for a long time. I think it's got to happen at some point. It
Right.
is will happen. So
It is, it is happening.
it is happening.
Yeah.
So I think what's going to happen is we're going to not at the expense of Apple or Google, but I think we're just going to see a spreading out of performance, which will actually help benefit dividend growth philosophies, value philosophies, small mid-cap philosophies. And we're very well positioned for that.
You mentioned the rally broadening out, and people are looking at a lot of the names that are getting bombed out, and there are a lot. But if you look at the equal weight S&P, the NASDAQ, and the Russell, the equal weight, all three of those are within 3% of their all-time high. Now, at the other end of the spectrum, you do have, I was looking at this morning, there are 26 stocks that are down 40% or more from their 52-week high, not like their all-time high.
Yeah.
So 5% of stocks in the S&P are down more than 40%. 20% of the index, a third of the index. So 1 out of every 3 stocks are down 20% or more below their 52-week high. So in this market that we're in right now, where it's AI or nothing, you really do have to, for what you're doing, you have to be a good stock picker.
Yes, and that's where it goes back to the stock market as market of stocks. And I remember when I was at Merrill, and we were actually very bearish in 2007, 2008, but there's always something to buy. There's always something to buy, even when you're negative. And on the AI side, on the tech side, not all stocks are created equal. You have a lot of semiconductors and different kind of fundamental trends. The stocks that you talked about with respect to the equal weighted S&P. You know what? Why we remain so bullish, Michael, is because if you looked at the earnings revision trends, okay, if you look at the fusion index of FY2 versus FY1, just lost everybody in math, but it's just math. If you take a look at that, they actually were improving a lot better and a lot faster than the big cap tech stocks or the top 10 companies. So that breadth and improvement of fundamentals, we think is really what's led us to these new highs. So it also proves that, you want to focus more on stocks. Now, that also increases your risk, but at the end of the day, you have to be able to have a process and a discipline that kind of helps diffuse some of that risk.
There's an argument out there. Our mutual acquaintance Adam Parker wrote about this week, where he's looking at the dispersion amongst the Mag 7, and he made the case like last earnings quarter, Meta was the best performer. This quarter, it was the worst. He looked at NVIDIA compared to the other Mag 7s. Are they correlated or not? All of these things all year just go in and out. There's like no rhyme or reason behind good earnings responses in the stock price versus bad. It just seems like it's this company's turn to outperform or underperform. The case he's making is that the active bets that you should be making might be away from the Mag 7 and just have those be a market cap weight, because there's really no way to know or understand why they're moving in the same direction or against each other. Whereas lower down in cap size, you could probably have less over and underweight, but have an even bigger impact on your portfolio results. What do you think about that idea?
I think that's 100% spot on. And we've been underweight the Mag 7 because we don't own a couple of those stocks in there.
Okay.
And we've been overweight other areas of the Mag 7. That's kind of number one. Number two, look at last week, right? Look at last week on what Meta did versus Google. So you're starting to see a differentiation with respect to fundamentals. Now, does it change next quarter and it's going to be another stock? Could be. Yeah. But at the end of the day, that's why it makes sense to be more neutralize those and then overweight the rest.
Right.
That's why, for instance, we're very, very blessed and fortunate to own Oracle since 2014. Part of the reason why
not in the Mag 7.
Not in the Mag 7.
Mag 7-esque performance.
Yeah. So, but we bought that company because of the balance sheet and the cash. And you really want to bet against Larry Ellison? No. I mean, the dude owns a Hawaiian island. I mean, come on.
Yeah.
But now what he's been able to do and what they've been able to do in Oracle the last couple of years to really take advantage of what's happening in the AI side, that's an example of finding a stock that's not a Mag 7 that has done amazing.
Right.
And Broadcom's come and gone from the Mag 7 if you keep looking, but we've been there for a long time too. But our thing with owning 50 stocks goes back to you don't have to be the smartest guy in the room. Don't need to know everything. You don't have to own everything. One of the things with institutional clients, I used to when I was last week talking to an institutional dividend growth portfolio manager. They own 250 stocks. in their portfolio. How do you
in one strategy?
Yeah, man. How do you make a difference in that? You have 20 basis points here, 15 basis points. I'd rather make a bet and have a process in terms of looking at that particular discipline to really make a difference. And that's how we.
Do you think there's like a pendulum though, where the market wants one thing, and then another period of time where it wants another? Like there's a moment where everybody wants to own everything, diversification, and then the pendulum swings, and it's like the hottest products on Wall Street are concentrated.
So earlier in the year, think about after Liberation Day, when all of the names that were exposed to China and the AI trade got smoked. You know what didn't at all? Berkshire.
Right.
And if you look at the full picture year to date, Berkshire, the gap was so big in April between the S&P and Berkshire, and now it closed and went the other way because now all that anybody wants is AI. It's sucking all the oxygen out of the market.
I keep thinking about this AI stuff and the AI stocks now relative to everybody likes to make the comparison of 99 2000. I think it's absolutely not that. It's not anywhere near that. Do the price performance stuff, the valuation, sure, but if you were in the business back then, if you had a .com on there, it was going up. It was going up.
There's not some version of that right now.
There might be there might be a little bit of it, Josh, but I mean, literally anything in technology. If you go back to look at also private wealth positions, equity positions in 99 2000, okay? 90% of their total investment positions were stocks, okay? Yeah. And 100% were tech stocks.
Yeah.
Why did they get? Because they weren't diversified.
Well, you had the money taken away from you if you weren't allocating to tech. We're not quite that extreme now.
We're not that quite extreme. And I'll even go back further. I remember in the very beginning of my career in 1990 back at William O'Neill & Company, and we'd have all these famous dignitaries come through, Peter Lynch, and talk about mutual funds, and who you guys had the amazing fortune of seeing. Oh my gosh. Anyway, there used to be a 10-year track record. Then there was a 5-year track record. Then there was a 3-year track record.
Quarterly. How'd you do last quarter?
Right. Yeah. What have you done for me lately, Janet Jackson? But it actually did change in the late 90s to a 1-year track record because of what was happening. These guys had to get paid.
To me, I think the biggest difference between then and now is the margins on these companies and the moats and the growth and all that sort of stuff. So there's this company called Duality Research that does amazing work. And they showed the forward PE, which everyone's talking about. It hasn't been higher in 20, whatever it is. It's not cheap. He says, okay, but you have to look at profit margins because profit margins are also at an all-time high. So he adjusted the forward PE, and he says it comes to 17.75 times, less than one standard deviation above its 20-year average of 16.2.
Adjusted for profit margins, meaning comparing this to...
Yeah. So he says, if this is a bubble, it's probably the cheapest bubble in history.
Yeah. I don't, going back to the bubble thing, well, let's talk about profit margins first. Part of our process.
I mean, sorry, but look at these forward profit margins.
Right.
Why would the multiples not be high in this type of environment?
Correct.
But the second question to this is, how sustainable is the rate of that profit margin rising? Because it's not the absolute level of the profit margin. It's, does 14.5 go to 16? Maybe the answer is yes.
Oh, if that stalls out, yeah, you're right.
Yeah, maybe.
That's really the question. That's what puts an end to this, is when that goes into reverse, if it does.
Well, that's why, as part of our process for when we started publishing the chart book, late 90s, is that you look at valuation, you look at earnings growth, and then you look at operating performance. And we've been studying this for years and years and years, and you have to look at all of these things. I think too many people only look at earnings or only look at valuation or only look at price. And I think this is what a lot of people are missing. But the term bubble, I think, is the most overused term in investments, just like dysfunctional family is in terms of, how families are. By the way, all families are dysfunctional.
In their own special way.
Exactly.
Yes.
We'll see that in 3 weeks at Thanksgiving. Anyway, just because asset prices go up doesn't mean it's a bubble. You know when it's a bubble? When the man's making money. Who's the man? Everybody. Financial services. If you think about this, think about 99 2000, the IPO activity, the secondary activity, the M&A activity. You had all these deals, not just one or two, but all of them done with stock that was meaningless. It had no value. And you had all-star analysts, you had rock star bankers frothy, frivolous. We're nowhere near that.
I was yelling about it this morning with Ben. To me, words matter, right? People are throwing around the term bubble. To me, a bubble is, and I know it's shorthand for expensive. I get it, right? I always say too. But a bubble, a real bubble, is one in which there is no roadmap. There is no possible scenario to which future cash flows can justify today's prices. No way, it cannot happen. Like impossible. There's no model that you could show me. And that's not what this is. And then also the second part of that is that, and so therefore, asset prices must correct. And don't give me 50%, because Amazon and Google fell 50% in 2022. Asset prices must correct by at least 50, 60, 70, and not rebound in 2 quarters or 2 years. They must go down and stay down. So you could say stocks are expensive and we're going to have a bear market, sure. But a bubble to me is which there is no possible justification for today's prices.
Go back to the moat thing, right? Because that's really important, or whether or not it's from an operational perspective or a cash perspective. Let's go look back at 2 of the poster children, Lucent and WorldCom. I mean, they had nothing. I mean, that was part and parcel where we didn't have a 50%, we had a 90% pullback. So we're going to have, I don't know.
But they were selling a lot of equipment right up until the end. It's not as though Lucent were masquerading as a company and didn't have an operating business. The thing that created the top was the orders started to be canceled because all of the equity offerings that were financing the purchase of that equipment stopped coming in.
Right. So
Lucent doesn't know that until it's too late.
No, because they created a capacity situation. So that's another big theme in investing, over capacity. You want to buy the scarce asset and sell the asset with lots of capacity. So going back to the new firm, Humalis, Humilis Investment Strategies, we're trying to create a scarcity proposal that we're going to have equity portfolios that aren't just one thing, but also provide for the market dynamic and then also overlay our years of experience.
Do you think when people talk about where we are today, I feel like after listening to Microsoft and Amazon and Google, you can't say these stocks are in a bubble. I feel like most people would say they deserve what's happening.
In one special way, though, people can say it. They don't like the circular financing of not only the product sales, but the build-outs of facilities. And I was listening to Gerstner on his podcast talk to Satya and Sam Altman together over the weekend. And he asked the question flat out, how could a company doing $13 billion have $1.3 trillion worth of financial commitments? And he sort of asked it tongue-in-cheek because he wanted Sam to have a snappy comeback, and he did. Starting with, we're doing way more than $13 billion in revenue. But he then subsequently dropped off the pod and said, gentlemen, I have to go.
So that's
that
why
fuels people's, but when that stuff happens.
He really did?
He really did. Wow. And Satya finished the interview. Now, for all we know, and I haven't asked Brad about this, for all we know, it was planned. And Sam said, hey, I have 20 minutes for your show. I can't do the full hour. I have no idea. But I'm just making the point. People don't like the circular nature of a lot of the deal making, the overlapping. We'll give you revenue for this, you give us revenue for that.
Right.
And that is what gives rise to the bubble talk. It's not just about valuation, it's about the structure of the deal making. And I think we could all agree, any company that comes out and says we have a deal with NVIDIA or a deal with OpenAI, it's an automatic 10% pop in the share price.
Except
one.
No, wait, no, but that I was just going to say exactly what you just did. And that's not Apple, that's not Microsoft or Google. We're talking about OpenAI and Anthropic and
which don't have share prices.
So OpenAI. All right, so let's just say they're doing $20 billion in revenue, whatever it is. Okay, it's not 13, it's 20. Maybe let's say it's 25. They're looking to go public at $1 trillion. Guess what? They better get to $100 billion in revenue. Now, you might say, and I don't know anything about this, Michael, there's no roadmap for OpenAI to get to $100 billion. Fine, maybe that's the bubble. But is it in the public market?
Yes, because think of how many of these companies are reliant on OpenAI continuing to spend at the rate it's spending in order to keep reporting their numbers. And that's the part that people are saying, we're not calling this a bubble because Microsoft's 100 times earnings. We're calling this a bubble because the revenue growth is not sustainable if somebody kicks out one of these legs to the chair. I'm not suggesting I'll be the one to see it coming, but I don't dismiss the bubble concerns as easily as somebody who just compares PE ratios.
Yeah, we're in the same boat. And I kind of go back to my O'Neill training as well. Like, stocks are rarely
Shaquille?
linear.
Yeah, Shaquille O'Neal taught you a long time
Will
ago.
O'Neal.
Right.
Bill O'Neal, the great Bill O'Neal. Stocks are rarely linear for long. So, uh, call me cynical. Why, Belski, are you opening a firm at the top of the market? So my comeback would be, well, I don't think we're not at the top of the market. We still think we're a big.
It was funny that you said that upon your announcement. I think you're a little bit self-conscious about, oh my God, what if it is the top? And I chose to launch my firm the same day.
Well, I mean, again, that comes back to the humility or self-deprecating.
Yeah.
But I our call is that a 25-year secular bull market started in 2009. I know you and I have talked about maybe different. Maybe it started in 2011.
Whatever. Close enough.
13.
Yeah, 13.
Yeah.
Potato. But I think we got about another 10 years to go. But we are going to have a recession again. We're going to have a bear market again. We are, before this big secular bull is done. And it maybe is one of these frothy people failing or really tripping.
Small mid, a partial defense against the unwind of the AI bull if and when it ever happens, meaning market cap comes out of the Oracles and out of the Microsofts and looks for a home in an area that's not reliant on OpenAI getting to $1 trillion. Like, is that a possible story?
I think all three strategies are, meaning dividend growth, value, and SMID.
You think they'll act as a counterweight in a portfolio to some extent?
I do, depending on how bad it is.
I think they could. Yeah.
I do, because, again, if you go back into SMID in particular, I know a lot of people have talked about, the Russell 2000 aren't making any money. Well, you can't make a broader index thing. You got to look at the companies. The S&P 600, it's got lots of cash in the companies. Some of them are paying dividends. The mid-cap index, the MID within the S&P, looks really great as well. And you combine the two, there's a lot of great ideas. So if you think about like I already mentioned Celsius or Shake Shack or Chewy, these types of names that have nothing really to do with AI. Or I love small cap financials like Glacier Bancorp in Montana. It's an amazing company. Or First Citizens is a roll up a lot of. These smaller banks I think are very well positioned from a relationship standpoint, just like the big banks are. We love financials in general from the value perspective. But I think that both those areas, meaning SMID and value, are going to be huge winners through this. And I do think too that there's not enough dividend growth investing either out there. So I think I go back to when I was.
We don't like the taxes.
No, we don't like the taxes
relative to the buyback.
Well, just reinvest the dividend.
No. We don't want to pay the taxes on the dividend.
No,
I was looking at Ford versus GM.
Yep.
I don't know that there are huge differences between the two. I know Ford's got the best-selling truck. GM's got more high-end luxury SUVs. I get that. But the really big difference seems to be GM's return of capital to shareholders is almost all in the form of buybacks, and Ford's is almost all in the form of dividends. I don't know. Like, I feel like it's a pretty big difference. And I don't know what else is very different.
I think that's right. If you go back to, I go back as a young strategist in the late 90s, and I remember marketing in Boston at Fidelity, and I remember meeting with a portfolio manager there, and he's like, Belski, he was a small cap manager.
Yeah.
He's like, Belski, I got to buy Microsoft to perform.
Yeah.
I don't know if we're quite there yet on that. But the other thing too is I wonder if there's got to be some data out there, chart guy can figure it out or something. I wonder how many value managers there are now relative to 10 years ago, or SMID managers.
How many left? Not many.
How many left?
And they have less money.
Yeah, or dividend growth. It's like straight down. That actually is a contrarian signal, right? Now, you have to have the fundamentals. Don't be contrarian just to be an asshole. Be contrarian if you have the analysis to back it up.
Or why it will change.
And I think that, again, let's go back to the dynamics of the market. I think we're going to have broadening out. If you have broadening out, that obviously makes it for more cyclical areas in the market, more cyclical areas within consumer discretionary, within industrials, and certainly within financials, which we still believe after all of this are still under-owned.
Which part of the financials? Because there's a lot of different areas.
Well, we still think it's a bifurcated market, meaning the really big are going to do well and the really small are going to do well. That's why I think the in-between, we're going to have mega mergers of these regional banks because they can't compete with the big and they can't compete with the small.
Yeah.
That's coming.
I just saw one. Who was it? Like 2 weeks ago.
Fifth Third and someone else. Yeah.
Right.
Oh, Comerica. They bought Comerica.
Yeah.
But there's going to be more coming. Because they can't compete with the really big. Now, honestly, too, here's some perspective. Think about the financial crisis, but even in the early 2000s, would you have ever thought that Goldman Sachs would be talking about private wealth in the early 2000s?
Yeah.
No way. What do
Yeah.
they talk about now all the time?
Right.
So I think that the big banks with the multi-divisional assets of wealth, consumer, commercial, institutional, very well positioned, right? The medium-sized banks, what we used to call the regional banks, it's gonna be hard for them to compete. I think the brokerage business is still a great business because it's scalable. The asset management business is scalable, but the small banks, these guys are cranking on earnings, and we think that they're going to continue to be a beneficiary, let's say, of volatility in the market.
You have a year-end price target on the S&P 500 at 7,000. I know you've consistently been more bullish than the pack in the last 10 years. In the last couple of years, you've sort of been still bullish, but like not quite as far ahead of the pack because everyone else is caught up to you. How do you think about just the idea of an S&P target? Do you even need to do that anymore, being more on the asset management side versus the brokerage side? What are your thoughts on where we are?
You know, it's a great question because we've written this piece called the Year Ahead piece, and I think I've written like 26 of them. In last year,
you have to do it every year.
Yeah, I got to do it every year.
You done?
I don't listen, man. That thing is 40. I mean, it's the smart guy piece. I don't, more for institutions, but we put our piece out earlier, as we do usually following presidential election years, because we wanted to give more guidance. And so we put it out in early November, right a week after the election. In our bull case for 2025 was 7,000.
So a year ago, going into the election, where were you?
7,000 for the bull case for 2025.
All right, so 68.56 today.
So we're here.
We're here.
But I'm not saying that to do this. I'm just saying that.
You did nail it.
Well, I mean, but what we said is that a lot of things have to happen. Now, we put it out earlier. The good thing now that we're going to be a portfolio advisory business, we can watch all the other people kind of put theirs out and see what, because in the past it was Belski puts his out early. And I'm not saying people copied me or anything, but for a reason, we put it out early.
It's impossible for other strategists to not shade themselves with things that their colleagues think or say publicly.
Of course, and
we're all human, right?
We're all human. That's exactly right. And when everything was going down in April, we said very clearly that if you're an advisor, man, right, and you're basing your business on a strategist target, come on, don't. Targets are an academic practice. They're an academic practice, and they're a have to versus a get to. We get to put out a target going forward. We don't have to put out a target, and we will put out a target. But what we said in April is we own what we own, man. We own what we own, and we didn't change anything. And we were very, very, very lucky.
So you deserve the commendations. You were one of the few that did not come out in the heat of battle in April and say everything we told you 3 months ago, throw it out. Stuck to your guns. I think investors were well served, paying more attention to you than anyone else. So congratulations.
Well, thank you for that.
What do you? Let's just close here. You're starting a business. It's the first business you'll ever be running. How excited are you? What are some of the first things that you think the public will see as a result of you being in this new position?
Well, one of the interesting things is I have an Oura ring and every morning I wake up, and about 3 out of the last 4 mornings it says you have major signs of a whatever because of the stress and you don't sleep, and it's very exciting.
It's butterflies. It's anxiety, man. It's everything.
I'm telling you, man. I on Friday when we changed our LinkedIn and we put our website up live, and we have people signing up for our research. We'll have research, and we'll have our portfolios up soon. It was try not to be emotional. It was overwhelming, the response.
Yeah.
And when you're in the weeds, man, and you're working hard, you have no idea what you're doing and your impact on other people. And it's just, I've heard from people from William O'Neill, Dane Bosworth, early 90s, from Piper, a lot of people from Merrill.
Like your fans come out of the woodwork and say, I've been waiting for you to do this, right?
Yeah. Congratulations. And then my great partnership at BMO, I mean, the brokers and the advisors up there are just amazing and sending me great well wishes and everything. It's so gratifying. But I don't I'm not doing that for that. I'm doing it because I wanted a new chapter in my life, and I'm super excited about being off on my own and doing this and being able to do what I love.
How excited are you for Brian on a
great.
scale of 1 to 10? I'm like an 11. Yeah.
So
I'm too.
what are you going to be doing for people that want to learn more about your services?
So we have our website up, Humilis Investment Strategies.com. Look it up. And we will be
not everyone speaks Latin.
HUMILIS.com. Nope, can't do that. But humilisinv.com or humilisinvestmentstrategies.com.
Perfect. Okay.
And we'll have our portfolios up and running soon. And we're hopeful to have BMO as a wonderful partner still in Canada. We're hopeful to have some great partners in the U.S. as well. And we're going to be portfolio advisory delivery only. We're not going to compete for assets. We just want to help people and run the portfolios. And I don't know if you know this about me, but I'm kind of an old school guy. Like, I believe that this business is all about relationships. If an advisor trusts us or broker trusts us to help them run their equity and they have some great clients, we will go out and meet that client. Because I think that's important. And I don't think a lot of people do that as much anymore. That's how I learned the business. And so I think we're kind of going back to that.
Ladies and gentlemen, audience, fan favorite, Michael and I, one of our favorite people we've ever met on Wall Street. We're so proud of you. We're so happy for you.
I am proud. Listen, you guys have been amazing. Like, seriously amazing. Barry and team, the entire family here has been so supportive of me.
Thank you.
And it means the world to me for everything you've done for me. And we're going to be great partners going forward.
Dude, so excited for you. You guys, check out Humilis.com, HumilisINV.com.
That's it.
Let's subscribe to Brian's stuff. Let's get on the list. And my man, good luck to you. Wish you all the best. And I know we'll see you soon.
Thank you, man.
All right.